We are moving in a world that won't be defined by active versus passive, but it's more complex versus simple, and then on a fee scale. So an index fund is systematic. It's just very simple and systematic, and you can literally see the algo, as it were, or like a DE Shaw or Renaissance on the other side, which is again systematic, but highly complex. And I think the world is just generally going from artisanal to systematic and a science data-led approach to investing.
Hello and welcome to Signals by AlphaSense, where we hear thoughtful insights from business leaders, investors, and experts.
Hello and welcome. You're listening to Signals by AlphaSense. I'm your host, Nick Mazing. In this episode, we're joined by Robin Wigglesworth, who is an editor at the Financial Times Alphaville, but is joining us in his capacity as the writer of Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. That's a mouthful, but it's true. That's actually exactly what happened. So now, if somebody follows you on LinkedIn, they'll think that you're a finance meme account because I think you're one of the best, you have one of the best games in the finance journalism industry. But so can you tell us a little bit more about, who you are and a little bit more about Alphaville, since people obviously know the main Financial Times product, but Alphaville, I think, is a little bit outside of that.
Yeah, that's very true. First of all, thanks so much for inviting me on, Nick. It's a real privilege and pleasure. Literally talking my book, one of my favorite subjects. Yes, I'm the editor of FT Alphaville, which is essentially the FT's finance blog, is the easiest way to describe it. It started off as, I think, kind of alongside some Deal Book and other variants in some of the dot-com-y era of the mid-2000s, but eventually just kind of evolved into being this kind of delightfully snarky, sarcastic, very smart, sophisticated, ideally, financial blog that we can be geeky and nerdy. So, we do use memes. We can even swear occasionally. We can break the strictures of normal journalism, but only in the service of ideally like making people smarter. So, we've written deep dives into is there determinations committees and how they decide CDS auctions, for example, or collective action clauses in sovereign debt bonds and how they've evolved since Elliott sued Argentina. More recently, we've been writing about obviously crypto going down the drain, the whole FTX implosion and the LDI debacle in the UK. So I'd say we love doing geeky, nerdy stuff, and the colorful memes, the images, it's kind of more of a way of making it more vivid and interesting. But maybe sometimes people don't really realize how important and also how fun this can be as well.
Yeah, and one thing that I really like about memes is that even though we as a society disagree on almost everything, right? The meme as a vehicle for showing a certain idea is agreed upon. It's universal. So whatever the meme is, chances are you know what the other person is trying to say, even if you disagree with it. And I think that's what makes it fairly powerful. So now let's literally talk about your book. Out of all the possible finance topics, right? I mean, it's a pretty big world. Indexing is like white bread. There's no libraries named after indexing. There is no sports arenas or anything like that. Why did you pick indexing?
Well, because it's important, basically. As a journalist, the subjects that really fascinate me are the ones that are hugely important, but don't get enough coverage or get bad coverage because it's too boring or too complicated sometimes. And markets and finance, they work on narratives. Memes are kind of basically the condensed narrative, right? And humans love narratives. So we like it when a human fund manager says, I'm buying X because of Y, or I screwed up this year because of central banks. Normally, they always have somebody they blame. And the humble index fund didn't really have that much coverage because you can't really interview the index fund. If I want to write about active management, what markets are doing, I can call Will Danoff at Fidelity. You can't really call the S&P 500. So I thought it was important, and it was really changing the fabric of financial markets. When I first started covering finance years ago, it was kind of obvious. It was early days. When I really started covering it full time was when I was the US markets editor at the Financial Times in New York from 2015 onwards. I decided this was going to be one of the main subjects I wanted to own because I thought it was important and misunderstood or underestimated. And that eventually became an entire book when I started digging into the origin story of indexing and realized that actually you can look at it just as like an invention, like the airplane or maybe the original fintech, because the index fund kind of was born out of the first uses of data and computers in finance. It is literally how it started. It is the original fintech story. And the people involved were just fascinating. Absolutely, absolutely fascinating. So when I discovered that, it was like, holy cow, I think there's a great book here. And how good it is up to readers. But at least I loved writing about it and researching it myself.
I mean, I enjoyed the book, and the history you presented, how it all came together. I think it's important to know, really all the things that had to go right, and all the right personalities at the right places, right? So let's say Jack Bogle not getting along, which is pretty normal for entrepreneurs. They scored low on agreeableness. You look at the kind of the personality dimensions. Like I scored low on agreeableness, so it's very relatable. But what I thought was most interesting is in the second part of the book, you actually stop it with the history and you look at, potentially the issues. And I'm not using this as a, people say issues when they mean problem. It's simply a thing. It's an issue rather than thing. So number one, governance. So when you think about how successful indexing is being, and I'm forgetting the statistic you have in the book, but let's say 80% of the S&P 500, the top three shareholders are Vanguard, BlackRock, and State Street. And some would say, and I think it's not an unreasonable thing to say, that it creates an artificial choke point for political agendas. Now, obviously, ESG is a big thing, but it's not just that. And I should clarify that BlackRock is an investor in AlphaSense. They're in our capital structure, so I'm going to say good things about BlackRock just so people know. And for example, BlackRock recently introduced what you could describe as pass-through voting, where the larger investors in certain BlackRock funds actually get to own their own shares rather than BlackRock owning them on their behalf. So, is that governance or choke point or whatever you want to call it a real problem?
Well, I think choke point is maybe not the right term for it, but I do think this is the biggest issue when it comes to the rise of passive investing. I mean, I read through old pensions investment magazines and Institutional Investor, Wall Street Journal articles about this going back to the 60s and 70s. And, many of the criticisms that we now see about indexing, frankly, people used to level at mutual funds 100 years ago. They're frankly not very original and they're not very rigorous or based on actual data. It's more people defending their turf. But I think the economics of scale in indexing is so obvious that the big are already huge and they're just going to become bigger and bigger. And this was something that worried even Jack Bogle before he passed away in 2019. I think it's basically that would have been probably something we should be aware of anyway, but it's not unique in the history of the world. If you look through like the US capital markets or European capital markets, it's not new that there were certain big investment funds or plays that were hugely influential, whether it's John Pierpont Morgan or the investment trusts of the 20s. This isn't per se new. I mean, just look at AT&T's pension system 50, 60 years ago. It was the single biggest owner of US equities by a mile, and it was hugely influential. I think what is unique now today is that we are both seeing increasing concentration of ownership and increasing politicization of so many issues. And I think it's valid everywhere to look at this. But I think in the US, where frankly there is quite a lot of political paralysis and rancor, people look at alternative levers to get their policies through. And they go to where power is. And undoubtedly, there is power in corporate ownership and accumulated corporate ownership, which sits not just in the big three passive owners that you mentioned, but also in a Fidelity or a Capital or T. Rowe. And I think, look, both sides make a rod for their own back on this. But I think it's the kind of defining issue for the next 10 years, because, even if they decide not to do something, for example, BlackRock has generally been a bit more on the parapets than Vanguard. But even the decision not to do something is a decision with consequences given their reach. Vanguard just this week has been slated for pulling out of a net zero alliance of asset managers, whilst BlackRock is being slated from the other side. So I like, they try to do the right thing, but it's a very difficult path to navigate, I think.
Yeah, you make a very interesting point how that is an overflow of the political paralysis and polarization. I hadn't really thought about it that way. And I should also point out when you said that you read old magazines and things like that, I went through the notes in the book. I don't know whether it's a third of the book or so, because I was very curious how much research went. It is certainly very well researched. So
Love, I think, as well.
the second issue that you bring up in the book is that of, does the ownership concentration, where you have, let's say, the big three being a top three, top five, top 10 shareholders in so many companies, especially within the same industry, lead to anti-competitive behavior? In other words, because company A and company B, let's say two airlines, I think is the example you used, have you seen evidence of the ownership concentration leading to sort of anti-competitive behavior, where because they're owned by the same companies, essentially they place the right directors, and then any sort of price competition or something like that stops and it hurts the consumer?
I mean, it's a fascinating subject, and it's sort of the pointy end of the broader concentration issue. This is like, how is it really impacting corporates on a ground level? The classic example is airlines, where some economists have done some research and found quantitative evidence, at least, or linkage between when there is horizontal cross shareholding or common ownership, depending on what sort of academic term you use, seems to lead to less competition when it comes to airline routes. The classic example of this is actually Berkshire Hathaway, that owned a big chunk of several airlines. So it's not actually just a passive issue, but obviously it is the most acute or most pertinent to index funds because they own a little bit of everything. And I think critics of the common ownership theory sometimes unfairly portray this as the academics pretending that BlackRock and Fidelity and State Street and Vanguard are getting together in a smoke-filled room and colluding somehow, like very old school anti-competitive behavior. And it's not that at all. The idea is that if you are the CEO of an individual company and you know that your biggest shareholders are also the biggest shareholders in all your rivals, is there at least subconsciously some sort of impact that dampens your will or urge to compete? Now, I think actually, in theory, there is. And that's why I spent quite a lot of time discussing this in my book. And I think it is a huge subject. But I should stress that I'm personally at least unconvinced, because as we know, CEOs act on a host of different incentives. The biggest of which is they want to jack up their own share price. They don't give a shit about their rival share price. So if they are better served with being aggressive in competing against their rivals, which most of the time they are because they got share-based comp, they are going to do so anyway. And also, frankly, the idea that the index managers benefit from this is also, I think, is a bit silly, because frankly, they do basically own a cross-section of the entire economy. So even if they have an incentive to keep airlines from competing against each other, well, that might dampen air travel and that might hurt their hotel stocks or other travel stock, right? So I think like the incentives on the asset management side just isn't there. And I've talked to some of them who said, look, if this was actually happening, this would be a bad thing for us. And this also just, the most problematic thing is the airline industry is the best example, but it's also a terrible example because it's a famously bankruptcy prone industry, right? Nobody thinks of airlines and think, oh, well, that's a monopolistic, oligopolistic profit margin machine, right? It's basically, Richard Branson famously said the best way to become an airline millionaire is to be a billionaire and invest in an airline. But I think it's a big topic that isn't going to go away because we are seeing this cross shareholding just get bigger and bigger and bigger. And like even the Federal Trade Commission has been looking at this, as has the European Commission.
Mm-hmm. Now, let's talk about another angle of, in indexing, and that is, and I don't know what to think about it, but is indexing aligned with fiduciary duty? And I'm going to clarify the question. So imagine, you're a regular person, you have a financial advisor, they have a fiduciary duty towards you. In other words, they have to put your interest above their own interest. And you go to them and they say, okay, based on your risk profile, age, things like that, you need to be, let's say, 70% in equities. And here is this 500 companies that I know absolutely nothing about that you should put your money in, right? In other words, the fundamental analysis is removed. And currently in the United States, at least, placing regular clients in an index fund is what is considered the correct thing to do for somebody who is a fiduciary because of, past performance and things like that. Is there a fiduciary angle where indexing is not exactly aligned with fiduciary because there is no actual analysis of the assets that are being purchased? It's looked at the higher level of this asset class.
It's an interesting subject, but I actually would argue that the fiduciary duty clearly speaks to investing more passively. And frankly, this is why we have seen a wholesale massive adoption of passive investing by the fiduciary oriented financial advisory community. And in countries where there is less of a defined or clear duty in that respect or legal requirement, you actually have seen the adoption of passive be a lot slower. I mean, I'm thinking about Europe, where if you go to your local bank, it's a very bank dominated market. And lo and behold, your bank advisor will typically advise you to put your money into the bank's own expensive active funds. I do think there is a more philosophical debate about what is fiduciary duty. And, in the US, I think it's called the good man or the wise man or the prudent man doctrine. But for me, it's just the data is so unequivocally in favor of a passive approach that arguably even more money should be going into passive strategies than there already is. Because, I mean, mathematically, in the US large cap space, I think on any rolling 10 or 20, 15, 20-year period you look at, there's only a 10% or 5 to 10% over the past 40, 50 years of large cap asset managers beating the index. And that's basically what you'd expect from random charts, right? Arguably even less. And I think it's getting harder and harder. The active performance of classic mutual fund is actually getting worse, not better, because more and more, frankly, dumb money. So the stockbroker punting stuff for his golf buddies, they've been kind of driven out of business, or they're slowly going out of business. The classics of day trading, dentists in Daytona, they aren't doing this anymore. And that's why markets are getting more efficient. Active managers are competing against not just some yokel in Florida. They're competing against Ken Griffin and Jim Simons, right? People have hired hundreds, maybe even several thousand computer scientists and PhD economists. So if you look at the data, it speaks in favor of passive. And that, I think, it speaks quite clearly to your fiduciary duty of what you should do at any given time. I do think there is an issue that, if everybody does this, does that lead to problems? The classic tragedy of the commons. If, let's say, everybody invested passively, the markets would not work. And I always feel it's like this truism that people trot out as if it's profound wisdom, but it's just ridiculous. And like if everybody ate batteries, we'd all die. I mean, it makes no sense. Yes, if everybody was passive, there wouldn't be a market, but that is never going to happen. And anyway, there is no such thing as truly passive anyway, right? People aren't just putting their money into the Vanguard 500 fund. They're putting the money into Russell 3000 funds, Schwab total stock market funds, dimensional small caps or mid caps or value funds. The entire index or passive environment is also quite vibrant and is not just all plain vanilla beta, if we can even decide on what that even means. So I tend to think that actually markets are getting more efficient. And that's a mix of more quantitative investors and passive investors replacing kind of the dumb index trackers that used to exist. Because the dirty secret that everybody in the asset management industry will admit after a couple of drinks is that a lot of people charge very big fees for basically being an index tracker anyway. I remember talking to the head CEO of one major asset manager, one of the world's biggest asset managers. And he said, looked at the data, and he said over the past, this was in 2019, I was talking to him, and over the past 1 year, 3 years, 5 years, and 10 years, there was $8 trillion worth of money in funds have underperformed over those periods. $8 trillion worth of money that had just sucked for over a decade, and people just hadn't pulled their money out. And I think actually I want more of that money to go to passive, and I think that will make markets frankly more efficient rather than less.
My fourth question is specifically directly related to indexing is exactly that: is
Yeah.
indexing too big? Because the way I see it, and obviously I haven't done nearly as much work as you have on that. Have you seen quantitative estimates? At what point would you end up having some kind of problem? Because it is a free rider problem in a way. So let's say when you look at the largest pool, it's the S&P 500, and to get there, right, somebody has to actually decide to bid up the price of that company to be considered. And that's by the way not to dunk on the S&P 500 inclusion criteria, because they're genius in their simplicity, right? You have to have a certain market cap. It's not a hard line, right? But which in my view is a proxy for price momentum or something like that. You have to be profitable depending on the exact certain number of quarters and so on. That's a proxy for quality. More recently, they introduced they're no longer getting dual class share stocks. That's a proxy for governance, right? So it's kind of smart, but does it get too big at some point?
Maybe, but I think we're decades away from that. And, it boils down to, and this becomes almost a philosophical question, but what makes a market? Multiple participants, right? But in reality, capitalism works all across the board with, only not that many players. Like if you buy batteries on Amazon, do you think that market is broken? Does that not function because basically you're just bilaterally buying batteries on Amazon? No. Capitalism is pretty good at picking up market signals without, frankly, thousands, if not tens of thousands, if not millions of people in nanoseconds trading all the time. What is actually the value or importance of that? I think markets, actually have that there is a huge societal value that people don't always appreciate in their being liquid and dynamic and constantly adjusting to things. Sometimes they over adjust and sometimes they under adjust, as we know, but I think that does have a societal value. And index funds are freeloaders on the price signals being set by active managers. But look, there are more mutual fund managers in America today than there's ever been before in history. There is more trading in volume today than there has ever been before in history. There are more hedge fund managers than there have ever been before in history. There are still, and this is one of my favorite stats of all time, there are still more hedge fund managers in the United States than there are Taco Bell managers. Do you really need all these people that are essentially glorified beta charging 1 or 2% or 2 and 20? No, we don't need that. I mean, that feels terrible to say this as a financial journalist. My profession is not exactly the most economically successful in the world. And some of the smartest people I've met in my life are investment managers. By far, they are smart, hardworking women and men doing, I think, sometimes God's work. But there are too many of them, and they charge way too much money. There is just massive rent extraction happening. And frankly, if you talk to a Ken Griffin or a Jim Simons or Warren Buffett's talked about this very loudly, they admit this, they know this. There's too much mediocrity in that industry. And if you are mediocre in investment management, you're actually a net negative to the world. Because of the fees you charge and the money that it costs to do what you do, you're actually subtracting value from the net pie of wealth, as it were. So my ideal world would be a far larger passive slice. I mean, God knows when things start kind of getting funny, but I think we could go to like 18, 90%. And there's 10% of the asset management community that's still active and truly active, will be more quantitative, less sort of have a hunch, buy a bunch, go to lunch, old discretionary style fundamental investors. And they will ensure that markets stay basically pretty efficient by constantly trading off minute signals that come from, all this digital data that we're constantly creating all the time. So I think we are actually heading towards a more dynamic investment universe and at the same time, a more dynamic market environment at the same time.
I think we need to schedule a separate episode to really see how you feel about active managers. Now, let's go back to the book. After the book came out, I'm sure you hear from a lot of random people anyway, because you're visible and influential. But after the book came out, I'm sure you heard about some things that maybe you didn't know about, or what surprised you the most from the feedback after the book came out?
It was interesting. I mean, the feedback was both sides. Like, I got a positive review from Burton Malkiel, the granddaddy of efficient or kind of a random walk in the Wall Street Journal, and even Paul Singer, who hates index funds and passive investing and thinks it's become a blob devouring capitalism, also praised my book and said it was his book of the year. I got literally screamed at for 5 minutes by a former Fidelity manager at one conference call. And I got an email from the CEO of one of the biggest hedge funds in the world saying he loved his book and agreed with absolutely everything in it. So I guess maybe I just wasn't surprised by that, but it was nice to see, frankly, getting praise and criticism from both sides of this argument, as it were, because sadly it has become a kind of a silly two teams style argument, which I think is silly because, frankly, look, I disagree with myself quite often, like several times a day. And I change my mind all the time. So I don't always know 100% what I think about these things. But of the interesting stuff, I think the lack of pushback from me saying this is going to grow just huge. And this is actually one thing that frankly informed the reason why I wrote the book. The argument is no longer active versus passive. Passive has won the argument. You will not find an active manager, whether it's a Paul Singer or anybody else, saying that passive does not have a huge role to play for most people. It's more about the negative externalities of its already pretty incredible growth and how much it's going to grow in the next 10, 20, 30 years and how we can best manage that. And I try to get into some of those arguments in the latter chapters of my book, but they're so difficult. Right? Because there are no easy answers. Like, how do we deal with governance? Do we just arbitrarily split up BlackRock? I'm not sure that actually helps. If there's BlackRock A and BlackRock B, does that really help the governance issue? So I think the real thorny issue is the consequences of where we know we are heading now. As you said earlier, I think, passive is won now. We're really talking about how total the victory is going to be and what shape passive is, because frankly, but one of my pet peeves, even when I talk about these things, is that even active and passive, there is no thing as passive, right? Even like you say, if you choose an SP 500 index fund, you're choosing 500 stocks chosen by the index committee of S&P Dow Jones. Everything has an active component to it. And I think as index funds start, there's a lot of innovation happening in that space. I think the always pretty blurry line between active and passive is kind of getting wiped out now. And I think broadly speaking, and this is my sort of my big galaxy level thought about this, is we are moving in a world that won't be defined by active versus passive, but it's more complex versus simple, and then on a fee scale. So an index fund is systematic. It's just very simple and systematic, and you can literally see the algo, as it were, or like a DE Shaw or Renaissance on the other side, which is again systematic, but highly complex. And I think the world is just generally going from artisanal to systematic and a science data-led approach to investing. And the whole idea that, discretionary asset management, I think that is going to, there will always be people doing it, but in 20 years time, there'll be fewer of them.
Robin, thank you for joining us.
No, thanks for having me on and letting me rant a little bit, Nick.
This was Robin Wigglesworth, author of Trillions and editor at the Financial Times Alphaville, who joined us today. We discussed mostly the issues arising from the growth of indexing. If you would like to learn more about the book or Robin, we'll have the relevant links in the show notes. My name is Nick Mazing. This is Signals by AlphaSense. You can subscribe to us on the major platforms. Thank you for listening.
Thank you for joining us. This was another episode of Signals by AlphaSense. Keep in mind that all views presented here are the views of the guests and hosts and do not represent the views of their employers or of AlphaSense. Nothing in this podcast constitutes investing, tax, legal, or medical advice. If you enjoyed this episode, leave us a rating and review and subscribe for more.